Credit card debt is designed to be confusing. It is a trap built on interest rates, late fees, and fine print. For decades, banks relied on you forgetting to pay. They profited from your mistakes. Then, in 2015, a company rose up in Silicon Valley with a revolutionary promise. We will kill your credit card debt for you. They were called Tally. They weren't just an app. They were a robotic financial genius. They would pay your cards for you, hunt for lower interest rates, and manage your entire financial life on autopilot. Investors went wild. They valued Tally at $855 million. They called it the Amazon of personal finance. But on August 12, 2024, Tally sent an email that shocked the world. No warning, no transition period, just, we are shutting down. How does a company with nearly $1 billion valuation, backed by the smartest investors in the world, disappear overnight? And more importantly, what happened to the money? To understand the death of Tally, we have to look at its birth. The year was 2015. Jason Brown, the CEO, wasn't your typical tech bro. He grew up in a family that struggled with money. He saw firsthand how credit card interest, APR, could destroy a family's stability. His idea was brilliant in its simplicity. Tally would give you a line of credit at a lower interest rate, say 15%, to pay off your credit cards that charged 25%. It was simple math arbitrage. You save money, Tally makes a little interest, and everyone wins. For 7 years, it worked. Tally paid off billions in debt for Americans. They were the good guys of Fintech. But there was a hidden flaw in their business model. A flaw that would only reveal itself when the economy changed. Here is the dirty secret of Fintech. Most of these companies don't actually have money. They borrow it. Tally wasn't a bank. They didn't have deposits. To lend money to you, Tally had to borrow money from Wall Street. Between 2015 and 2021, interest rates were near zero. Money was free. Tally could borrow millions of dollars for cheap, lend it to you, and pocket the difference. Venture capitalists like Andreessen Horowitz poured $172 million into the company. They didn't care about profit, they cared about growth. They wanted Tally to get as many users as possible, as fast as possible. Then came 2022. The party ended. Inflation hit 9%. The Federal Reserve raised interest rates at the fastest pace in history. Suddenly, the cost of borrowing money skyrocketed. For Tally, this was a death sentence. The money they borrowed from Wall Street got expensive, but they couldn't easily raise the rates they charged their customers without losing them. Their margins were squeezed. The math arbitrage stopped working. And worse, the venture capitalists closed their checkbooks. In 2023, funding for fintech companies dropped by 75%. Investors were no longer interested in growth. They demanded profitability. And Tally was not profitable. Imagine being the CEO in late 2023. You have 183 employees, you're burning millions of dollars a month, and the banks have stopped lending to you. Jason Brown had two choices: bankruptcy immediately or a desperate Hail Mary. He chose the Hail Mary. In April 2024, just 4 months before the collapse, Tally made a shocking announcement. They killed their consumer app. They told the world, we aren't going to help people directly anymore. Instead, we're going to sell our software to banks so they can help people. This is called a pivot to B2B. In Silicon Valley, this is often code for, our original business is failing and we need to find a new way to make money fast. They claimed they had a massive partner lined up, a company with 50 million users. It sounded hopeful. But building a B2B business takes years. Tally only had months of cash left. The clock ran out in August. The massive partner deal likely fell through or didn't pay fast enough. The investors refused to put in another dollar. Jason Brown took to LinkedIn to post the final obituary. He wrote, we were unable to secure the necessary funding to continue our operations. And just like that, the app stopped working. But this created a massive problem for the users. Tally wasn't just a game, it was managing people's debts. Thousands of people woke up and asked, wait, do I still owe the money? Here is the harsh reality of a fintech bankruptcy. The software dies, but the debt survives. Tally didn't own your debt anymore. In bankruptcy, the liquidators come in. They take the list of everyone who owes money to Tally, and they sell that list to other debt collectors or banks to recover the cash. Users didn't get a debt forgiveness miracle. They got a new servicer, often with worse customer service, and no fancy app to manage it for them. The financial coach didn't just quit. He walked out of the gym and locked the door. Tally is not alone. It is just one casualty in the great fintech call of 2024 and 2025. We are learning a painful lesson. You cannot code your way out of economics. It's easy to look like a genius when interest rates are zero. But when money gets expensive, the only businesses that survive are the ones that make actual profit, not just users. Tally tried to be the good guy. They genuinely wanted to help people. But in the world of finance, being good isn't enough. You have to be solvent. If you're using a fintech app to manage your life, ask yourself what happens if their funding runs out tomorrow. Do you have a backup plan? Tally proved that even the biggest unicorns are mortal.